Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, September 20th, and then we'll see how things look for Thursday, September 21st. Everything was all about the Fed on Wednesday, and not so much what they did. They left rates unchanged, but what they said. And what they said, the market didn't like. So that's kind of feeding into this idea that we're weak seasonally right now. The technicals are turning more negative, and we're just seeing a little bit of a development of a trend. And it looks like right now that trend could be down. Now, a solid up day, we could go back and change all of that, but we just have to go with what we're seeing right now. Let's talk about what happened. Right at the open, we had a higher open and prices rose, and then they were chopping along R1 at 44.57. That's pretty common. You see some initial gyration at the open, and then typically prices will just kind of chop along, waiting for the announcement to be made. As the day went on, we had the announcement that came out, prices chopped, and then fell below the unchanged level. So you had the initial gyration, and I have a 1-minute chart to show you here in just a minute. And we fell below the daily pivot at 44.37. We also fell through S1 at 44.24. We closed slightly below S2 at 44.04. So we're still a little bit above 4,400, but we're starting to turn more negative. We were down 0.94%, and volume was still below average. That's kind of interesting. The technicals, as I said, are starting to turn more negative in the short and looking weaker in the intermediate term. We're still okay in the long term for right now, and we're coming into that weak seasonal time. There'll likely be some hangover reaction to the downward move that we saw, at least at the open on Thursday, and then anything can happen after that. And I'll go through some of the things that the Fed talked about as we go through this video. So some comments that we can make. The FOMC announcement, even though they didn't raise rates, and the press conference together, they were taken as negative. On a short-term basis, our list is getting a little bit longer, but we are turning more negative. The Stochh RSI, the Williams percent R, the CCI 14, and now the stochastics are starting to come into the picture. The current scenario, we're wondering, is that going to develop into something new? Not right now. It seems like we're just going along with the scenario that we had been with, that the economy is stronger than expected. And even though that's not making rates go up, it is really reinforcing this higher for longer scenario, which the market has known for a while. It's not necessarily a surprise. They're just hoping that something is going to shift or pivot into a more interest rate friendly environment, and that doesn't look like that's happening yet. If we do see more strength economically going forward, that could mean that they may raise rates again, and they've definitely left that as part of the equation. We're also keeping an eye on the Chinese economy, just because there are so many S&P 500 companies that do business with China. And oil has been a concern lately, more from inflationary fears. It's going up not out of strength in the overall sector. It's more because of what Russia and Saudi Arabia announced as far as cutting back on production. That's making the price going up to go up. The dollar was up and interest rates were down. Interest rates going down could have given some support to stocks, but the dollar going up, and it's back up into the 105 range again. So it's showing some pretty good strength currently. And the yield curves that we follow are still inverted. Sentiment is neutral at 47. It ticked down from 48. And we're starting to see in the short term the possible development of a trend. In the intermediate term, the ADX is still below its moving average, and they're both below 20. I'm changing our bias to negative because of the down day, and it seems like we're leaning more that way now. And our momentum is also switching back to negative. The economic reports that came out, we just had the weekly MBA mortgage applications index, and that was up 5.4%. Refinance applications were up 13%. That's a pretty big jump. And purchase applications were up 2%. Now, here we're going to break down some of the things that were taken out of the FOMC meeting. They voted unanimously to leave rates unchanged. So we're at 5.25 to 5.5. That was not a surprise. And then there's this thing that I've alluded to from time to time called the Summary of Economic Projections, and that's SEP, because they like to acronym everything. And there's the dot plot where they're trying to figure out what's going to happen in the future. And this is showing that policy rates are anticipated to remain higher for longer. That's not unknown. That's something that the market has already been dealing with. And that this is kind of the new part, that Fed officials are not expecting to cut rates in 2024. The market was kind of hoping that would happen, and that it's actually less than what they thought at the last meeting. So it's looking more like we're not going to cut rates after all. And the market didn't like that. For over 2 years now, we've been waiting for this Fed pivot, and the market keeps anticipating it, even if it has to create it out of thin air, that the Fed's going to be done raising rates and they're going to start to lower them. And then it comes back. The Fed says, no, we're not there yet. So then the market freaks out over that. And then out of seemingly nowhere, they create this scenario again. And it's just this perpetual thing. At some point, the market's going to be right. But they keep trying to lead this because the stock market is a leading indicator. It just isn't developing the way the market thinks it should. And then it gets disappointed. At the press conference, Chairman Powell came out and said several times in that meeting that the Fed is going to proceed carefully. I mean, that's nice and ambiguous. And so that really leaves things open-ended for the market to try to interpret it on a day in and day out basis, what they think are going to happen. And the new scenario is probably going to come in again. We're going to get a couple of economic reports. They might be weaker than expected, or it may not even be justified that, maybe the Fed will be able to start lowering rates soon. And that's going to come in because it's been coming in so far for over 2 years now. Here is the mortgage applications index showing the increase up 5.4% month over or week over week. And then we're keeping an eye on this. We're at 5.34% for the 10-year yield. When we get above the 4.35%. And then when we get above that 4.02% level, that's when interest rates are getting high enough to start doing some damage to the earnings for companies, especially in the S&P 500, and justify stocks actually going lower. Here's the intraday chart. It was pretty quiet. We saw a little bit of a gyration right after the open, but we did open right at R1. That was higher. And we just danced along this level, saw a little bit of weakness, and then here's the gyration when the announcement was made. Then there was the counter move that tried to take things positive. And then when the press conference started, that's when people didn't like what was going on. We broke below the daily pivot, S1. We even closed a little bit below S2. Here's the 1 minute chart, just showing here's Tuesday's session and then Wednesday's session where things were chopping around, but not all that convicted. And then here's when the announcement was made, tried to recover up out of that, came back up to where prices were before, and then spent the rest of the day just going down. And we closed pretty much at the low for the day. Here's the intraday look at growth versus value, where they both declined, and they're both not doing very well right now. Here's looking at the growth to value ratio intraday, where we were negative. So that's doing some damage in the market. Here's the end of day showing that we did decline. We've been sideways for quite a while now, but we're still in a longer term uptrend. Keeping an eye on the VIX. If the market continues to go down, we will likely see this red line continue to follow along with the blue line. Here is the VIX, where we shot up with the line chart and the bar chart. We also saw volatility of the VIX pick back up, but we're still below the moving averages. So it's reacting, but it's not a real big reaction. The Ulcer Index, haven't shown this in a little while. We're seeing that picking back up, but it's still below its moving average. And the equity put call ratio based on 5 periods, this is still positive, where we are declining. Now, it's going to have to continue to do this, but if we start getting into a rough spot from now, especially till the end of September, this is likely to turn and go back up, but it hasn't done that yet. Here's a longer term look at that same chart where we did get to an extreme reading and we're starting to come down, but we have to take this in the context of other things that are happening. The VIX to VVIX ratio is continuing to decline as well. This also takes a bit of time for this to reverse if it's going to turn and go up. But for right now, it's something positive that we can hang on to. This is still negative, the 253 period simple moving average of the equity put call ratio. It's still going up, and this takes a lot longer to shift direction, but it hasn't shifted yet, so it's still looking more negative. Here's the advanced decline line where we did decline based on price and volume, and we're starting to come down to the moving average based on volume. This is kind of interesting, though. We actually, when the market opened a little bit higher, we saw some new 52-week highs actually increase. And when we were going down, we didn't see a big increase in the 52-week lows. So that's turning our 5-period back up, which could be a source of something positive. And we're flattening out a bit with our 10-period moving average. But when you look at the advanced decline ratio, we are dropping below the zero line, so that's turning more negative. And this is also negative. This is trying to gauge what the smart money is doing. We're below a declining moving average. And the chicken money flow is also negative, another smart money indicator that we look at. The NYSE cumulative advanced decline line, we're coming back down to this previous low. We have to see, is this going to provide some kind of support and then turn and go up? Or are we going to fall through this and go back to this previous low? We're also starting to break below the trend line with our regular advanced decline line. Here's another measure. This is also the NYSE advanced decline line, but a different way that it's calculated. We had been maintaining things above this upward sloping trend line. Now we're starting to drop below that. And then I haven't shown this in a while either, our advanced decline line studies. With the market going nowhere, these help to determine what's our trend actually doing. And so I haven't been showing some of these charts, but we're declining with the NYSE common stock. We're below the moving average, also showing weakness with the S&P and mid caps, and we're showing even more weakness with the small caps. The risk on versus risk off ratio is continuing to show weakness. That's also negative. Here's the trend. This is the intermediate term trend. We haven't crossed above the moving average yet, but the red line is on top and the green line is declining. If we go above this, that could be the initial stages of a trend, but it's not quite there yet. However, when we look at the short-term ADX, we are crossing above the moving average and the red line is on top. So if you're more aggressive and you like to go with the trend, you're liking this in the short term, but you want to see some follow through go into the intermediate term. The daily chart, just showing how we're below the 50-day moving average. We're also below the pivot points. You can see where volume and the bottom dropped to below average again. The Stochh RSI is extreme negative. The Williams percent R is also extreme negative. The CCI 14, which is our shorter term look at using this particular indicator, it's also extreme negative. And we're starting to get extreme in the short term with our stochastics, as well as the intermediate short term. And we're turning down now in the long term. So we're negative across the board here, but we're going down kind of far, kind of fast. But it's not that strange with these short-term indicators because we've been not trending for quite a while. So we get some kind of a significant move and it pushes these to an extreme reading. The force index is not extreme and continuing to show more weakness. The go, no-go system is changing to a smoke on the water, deep purple look here. That's more negative. And then we're coming down below the lowest low value here with the red line, and it's starting to turn down where the blue line is continuing to go sideways, and we've dropped below the midpoint. So this is turning more negative as well. We're also seeing continued weakness with the TTM squeeze, the darker shade of blue and declining, even though it's still positive. The balance of power also dropping below the dashed line with a little more velocity behind it now. So that's turning more negative. And we have dropped below 50 with the bullish percent index. That's turning this more negative. And we're turning down with the summation index based on price and in danger of dropping below the midpoint. We've already turned down based on volume and we're already below the midpoint here. So this is looking more negative in the intermediate term. And then the summation index, a broader measure, we're going down based on price and volume. And we're still negative and dropping below this line here. This is a longer term moving average based on 65 periods. It's part of the built-in indicator here. And other times this has acted as support. Well, when we were going up earlier in the year. We have dropped below this before, and then we're able to bounce back up, but just know that we're dropping below this again and negative. The mass index, we're wondering if a trend is starting to develop. It's looking like it could be negative, but this signal was actually triggered a while ago now, so it's not as relevant to what's going on. We're turning down with the PMO. We're starting to roll over based on price. We've already gone negative, and we're starting to turn negative based on volume. With our PMO studies, the rising PMOs are declining. We're turning down with the buy signals. We're flat to slightly declining with the PMOs that are above zero. This is also more negative. The Swenlin trading oscillator declining based on price and volume, where both are below zero. The NYSE bullish percent index below 50 and declining, but not a real big move. You could take something positive from this. And this is something a little bit positive. The NASDAQ 100 bullish percent index actually turned up, but it's still negative since it's below 50. We're still inside the Ichimoku cloud, but now we're coming down to the end of this, or the lower part. Are we going to break through this, or are we going to be able to bounce up out of this? And all of our oscillators are pretty much negative now, especially in the short term and intermediate term, rolling over with the tricks and the KST with our longer term oscillators. We're below all of these moving averages that we've been dealing with for quite a while. Now it looks like, okay, are we going to head down to the 100-day moving averages? We're not quite there yet, but we've broken below the 20 and 50 period moving averages. We're starting to get into the second, okay, try that again, take two. We're starting to drop below and get into the second standard deviation on this chart, where we had been kind of above and below the midpoint. Well, now we're looking more negative here. And we're dropping below this mini rainbow with our open, high, low, close moving average study. So that's turning more negative. The parabolic SAR remains negative, and we're dropping to the underside of our short-term rainbow. That's turning more negative. And then longer term with the MACD weekly chart of the S&P, we're also showing more weakness. The Heikin Ashi is turning more negative. The Kegi chart, it changed to negative after yesterday. It's remaining more negative after today's session. But the Renko, even though it had another block up here, it gave one of those up, but it's still leaning more positive. And the 3-line break is still starting to turn a bit more positive. The equal weight S&P 500 continues to underperform the S&P, and both of them are having some problems right now. And with the Dow, we came up to the pivot point here. We never got quite up to the 50-day moving average. We've been chopping more or less sideways with the Dow for quite some time. And on the positive side, you could say that we're just getting more into the lower end of this recent range. But we are negative when it comes to the Elders Impulse system for the diamonds. And we're looking more negative with the NASDAQ 100. We're dropping down below this previous high. We're below the 50-day moving average, but we're still above this S1 level. And I seem to need to clear my throat all the time when I'm recording. And the Qs for the Elder Impulse system are just a little bit below the moving average and still negative. And we're also showing our momentum with the PPO rolling over and turning back more negative. The NASDAQ also losing the battle right now for overhead resistance and starting to fall down, but we're still above this S1 level. And we're just showing this in case we continue to fall. Will we come all the way down to this 50% retracement level with our Fibonacci retracements of the NASDAQ? The FANG index continues to be below the 50-day moving average, but still in a longer-term uptrend. Small caps, and this is where we're seeing some weakness. We're breaking down below this S1 level, below the 50 and 200-day moving averages when we look at the small cap index. Turning even a little bit more negative with the Russell 2000 small cap index. Starting to come down even more with the RSI. We've closed 2 days now below the 200-day moving average. Other times this had acted as support, and you can also see some other support levels in here. We're starting to break below that, and the MACD on the bottom is also more negative. The Elder Impulse system for the small caps continues to be negative, and we're dropping below. You could see some support in here intraday, but we closed below that. We need to see some strength out of the small caps if we're going to turn back more positive. The mid caps also looking more negative now, closed down below their 200-day moving average. It had been holding up much better, but not as of Wednesday's session. And the Elders Impulse system for the mid caps also turning more negative, could be getting to the point where we're going to drop below support here. Or the market could really get a fire underneath it and use the support level to go back up. Looking at Dow theory, showing some weakness with the Dow, a little bit more weakness with the transports. We saw a little bit of a tick up with the utilities. The transports to S&P 500 ratio is kind of chopping around right now, but still negative overall. And here's a look at interest rates where they actually declined a little bit. We're coming back up to this previous high. We closed at that level after Tuesday. We dropped a little bit from there on Wednesday. And looking at Tom Bowley's research, where we're in that latter part of September now, where there tends to be weakness historically. So what's our outlook for Thursday? Still dealing with earnings, but not as many reports. The UAW strike is still continuing. We're still wondering if there's going to be some kind of a government shutdown in the near future. The student loan repayments, my understanding is they will start October 1st, and that could be a drain economically. The technicals are more negative now, and in the intermediate term, we're not trending. We will get the weekly jobless claims, the Philadelphia Fed Index, existing home sales in Thursday's session, and they'll get the LEI, even though this is not that important historically. Right now, it's one that I've been really focusing on lately. And then we're keeping an eye on the geopolitical events. Anything could come flying in at any time. But right now, it's about inflation, interest rates, and then reacting to the Fed policy. Here's the updated economic calendar for the week. We will get the S&P Global U.S. Manufacturing. We'll get 2 reports, and the services PMI. Both of those will be coming out on Friday. Not big influential reports. For the Stock Traders Almanac statistics, we're neutral to negative with the Dow. We're just flat out negative with the S&P, and we're neutral to negative with the NASDAQ, as we're entering into that weaker seasonal time. And we will be on the 14th trading day of the month, where you can see all of the indexes, even during pre-election years, do show some weakness. And then Carson is also showing weakness with their research on the 21st. This is when we're coming in for the NASDAQ, where we historically see some weakness. The S&P also sees some weakness during this time. Now, it could always buck the trend and go opposite. We're just looking at what has historically happened. And then going back to 1950, the S&P is only up 33.33% of the time during pre-election years. We're not going with the down one yet, unless you're super aggressive. Even though we're starting to develop a short-term trend, we're definitely not going with the up one, because our technicals just don't support that. So more conservatively, we're still leaning towards this sideways trend, because in the intermediate term, our ADX is not trending yet. We could be starting to see the start of a trend with the short-term ADX. The warning signs, we're still below the longer-term trend signals on the weekly S&P and NASDAQ charts. We're coming into a weak month, which we've already been in, and also a weak period of a weak month. The longer-term equity put-call ratio is still turning up. The risk-on posture is showing weakness. Our oscillators are turning negative, as well as the NASDAQ 100 oscillator that we've been watching. The cumulative new highs, new lows, that's longer term. They're still showing weakness. We're still above the 2007 level with the 3-month yield, and we're still waiting to see if that's going to roll over, and it just hasn't done that. I finally moved this over to the warning sign sheet. The Russell 2000 is below its 200-day simple moving average, which had been providing support, but now that support is being broken. The parabolic SAR chart is negative. The Copic curve buy signal, it's now history. The vortex indicator, it crossed negative yesterday and remains negative. And then dealing with earnings season. On the positive side, we do have seasonality and setups that are in the background. The daily special K chart, which takes a long term to cross that red line, it's still positive, but the weekly chart is negative. We're still above the downtrend channel upper line. The equity put-call ratio is back to turning down. The S&P is outperforming utilities, but we could be starting to see a shift here, as well as with the Staples to S&P 500 ratio. The small caps, both with the Russell and the mid caps are working off of golden crosses, but we're just seeing a lot of weakness in small caps now. Small and mid cap growth is still chopping sideways and remains positive. The financial sector actually didn't do that bad in Wednesday's session, and it's working off of a recent golden cross, but longer term, it's still quite negative. So our conclusion, we're negative. We're not trending in the intermediate term. We could be starting to develop a short-term trend. So we're seeing that a little bit with the trend, but we're already oversold a little bit in the short term. So we want to be aware of that. But those indicators still have more room to run to the downside. Intermediate term, we're still possibly turning more negative, and we're not trending at least yet. We're long term, we still remain positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.